Gerald Lucas here with another installment of Ask Gerald, where you get your real estate questions answered. Today's question comes from Susan, and Susan writes from West Orange, New Jersey. And Susan writes, do you think we should use our home equity line of credit to pay off our credit card debt? Well, Susan, although that doing that could certainly reduce the interest that you pay, certainly in the short run, using a home equity line of credit to pay off credit card debt is a high risk financial decision. And to clarify, if you do that, if you use a HELOC to pay down a credit card debt, you're not reducing your debt. You're just swapping one form of debt for another form. And the risk of using a home equity line of credit is that it's secured against your home. So if you default, you run the risk of getting foreclosed on and using your home, which is a consequence that can happen if you, for example, default on unsecured credit card debt. So to answer your question, does it make sense to use a HELOC to pay down credit card debt? Well, if your income is stable and you have a proven track record of managing debt and you're committed to not spending and accumulating more debt after you pay your credit card debt down, it may make sense to use a HELOC to pay down or pay off credit card debt. However, if your finances or income is unstable or less stable, and if you have a tendency to overspend, then the risk of losing your home to foreclosure may outweigh any benefit from using a HELOC to pay down credit card debt. Now, the reason why people are tempted to use a HELOC to pay down credit card debt is because the interest rate tends to be lower. So in recent history, a HELOC interest rate has been about 8%, whereas credit cards can be well in excess of 20%. Also, because a home equity line of credit is paid over a longer period of time, the payments are often smaller, and that may free up cash for you to invest in something else. But to recap again, the big risk is, a HELOC is secured against your home. So if you default, you could lose your home. Also, home equity lines of credit tend to have variable interest rates. So if the interest rate goes up, so does your payment. Whenever you borrow money from a bank or a lender, it's not free. They cost it costs money. So there are closing costs and often annual maintenance fees that go along with using a home equity line of credit. That could be 2 to 5% of what you borrow, for example. So assuming it's 5%, if you use a HELOC to pay down, say, $10,000 of credit card debt, you're replacing that $10,000 credit card debt, if it's 5%, with $10,500 of home equity debt. So you're actually borrowing more money. In the same way that if you transfer a balance on a credit card, it costs money. You're actually going deeper in the hole, and you're increasing your debt. But over time, if you don't rack up more debt, it may make sense. The one risk, though, is that people often, after they pay off their credit card debts, and they have zero balances on their credit cards and also a line of credit, there's a tendency for them to start spending again, and then they end up with more debt and in a tougher or a worse financial position than they would have been, for example, if they had just aggressively paid off their credit card debt in the first place. Also, because home equity line of credit is paid over a longer period of time, although the interest rate may be lower, depending on how long you have a balance on a home equity line of credit, even though the interest rate is lower, you may end up paying more interest because of the period of time that you're borrowing from than again you might if you had aggressively just paid down your credit card debt in the first place. So thanks for your question, Susan. For more real estate tips and information, visit my blog at geraldlucas.com. I'm Gerald Lucas, and I'll see you again soon.